Hello, Josh Lloyd here, Harcourts Real Estate. I've got Tom Haigh from Groundswell Property sitting here with me. Just wanted to first off say that this is by no means personal financial advice. This is general in nature, but we just wanted to jump on. There's obviously been a lot of noise of late in the media, specifically around the budget, and myself and Tom have had a few conversations about it. We like to keep up to date with this type of thing, and honestly, we just wanted to jump on here, have a conversation, let that conversation run really naturally, and just unpack a few things, really, delve into what is actually going on, what's actually been, put forward by the government, and what it could mean for, Newcastle house prices. Tom, over to you.
Well said, Josh. And I think at the core of this, the objective is to, try and provide some insight as to what we're seeing out there in the market. Ultimately, I think everyone's perspective on this is typically based off what we're seeing on social media, what we're seeing on the news, the headlines, and that's helpful to a point. But there's the practical reality of, the market and how those dynamics may or may not change. And that was, a big part of what we wanted to try and do today, to break that down and to look at, those sectors or those, tiers of the market that are going to be most affected, those investors that are going to be most affected, and potentially those homeowners who are going to be affected. So, obviously, as a starting point, the elephant in the room is negative gearing, right? It's that in reality is likely to have the biggest impact of any of the proposed changes, and worth noting there, isn't it?
That very much so. Proposed is the word.
So as to what gets through Parliament, that will be an interesting thing to observe from the sidelines. But negative gearing, or potentially removing negative gearing on existing investment properties, so established housing, will have the largest impact from my perspective anyway. The work that we do is with a lot of property investors out there who have got a bias towards residential assets. And a lot of those assets in good locations, desirable locations, are negative in terms of their cash flow. So if you remove that, let's call it an incentive or a tax incentive, if you take that off the table, then all of a sudden these aren't so attractive. And worth noting, of course, that you don't lose the entitlement to obviously that tax break or that potential to claim that negative cash flow back, but you're needing to wait a fair chunk of time to do that, obviously, until you sell in the future.
An interesting point. Did you want to maybe have a little bit of a conversation about how that negative gearing realistically, I think impacts borrowing capacity would be an interesting one to touch on, because I think that's going to really play a bit of a part if it does get through. But B, it doesn't actually get lost in nature. They're not losing the ability to negative gear. They're just losing the ability to actually use that negative gearing against the income.
Absolutely. Yeah, and I guess the counter to that, and worth sort of noting, is the wonderful thing about property as an investment is your capital gains are tax deferred. So it's not like if your investment property goes up by $100,000 this year, you pay tax on that.
Yeah,
the tax is payable on the gain at time of sale. So it's the other side of the fence to this. We're talking about the same thing, but for the negative cash flow or loss side of it with your cash flow. So look, I think that if I look at my clients and their appetite for residential investments, established homes, it will still be there. It will absolutely still be.
There's no doubt.
But it won't be everyone. If we're talking about investors representing, say, 30% of the buyers,
that's what we're saying before.
Look, we may lose 50% of those potential who can't make the finance work, who can't get the pre-approval based on that assessment not allowing the add back of negative gearing. So that's going to be a factor. But what we're also talking about is the most hotly contested part of the market right now.
And that's the thing, like the amount of investors who are actively going to be impacted by this, the highest percentage of them are operating in a marketplace where it is this convergence of first home buyers in the, call it, 850 to 1,050,000 range, right? And so you've got this convergence of first home buyers, and then you've got this convergence of investors, and that market has just exploded of late. And from a sales perspective, I can tell you that in that market, 70% first home buyers still, 30% investors. Mate, if I lose every single investor out of that price bracket, I've still got an incredibly hotly contested little price bracket.
Yeah.
So I think that there's maybe a little bit of fear mongering around it, the way that it's been delivered and perceived. And you, to your point earlier about, there's a lot of social media hype around what this is doing and everyone's a guru right now. But I think when you really strip it down, I don't know, maybe I'm going out on a limb, but I don't think it's going to be that bad.
Yeah. And time will tell. It's the age-old thing. We don't have the crystal ball, but we've certainly got some good precedents. As our friends across the ditch in NZ tried this in 2021, and there was definitely an impact felt very quickly. Within the space of a couple of years, the changes that they brought into negative gearing there were reversed. Locally, we've got to turn our attention back 40 years to the time of Paul Keating and introduced this in 85. Again, it was reversed within, I think, 18 months at that point.
By the same bloke who introduced it?
Correct, because I think what's sort of not been spoken about at any deep level is the issue around the new supply piece, because you can incentivise people to focus on new builds from an investment standpoint.
Which is what they're trying to do.
Absolutely.
In effect, the proposed changes are to try to increase the supply of residential property, because at the moment we have a lack of it.
100%.
And so that in a nutshell is effectively what they're trying to do. Yeah. We were having a very quick chat before we jumped on here, and I made mention that I actually think that they're going to go close to doing the opposite.
Yeah. And part of the structural issue with all of this is the fact that for it to be feasible to actually build a new dwelling for an investor, you need to be on the edge of town.
You have to. That's where the land is. That is where they can chop it up. That's where they can build.
Correct.
Is that a good place to invest your property?
So with that comes vacancy risk, and investors are pretty astute. It won't take too much time for an investor to see whether or not that is proving to be a viable alternative to what they previously focused on. So I think that will be very interesting to watch that unfold. And fundamentally, we've got another little issue on our hands, which is a construction cost crisis. Everyone is well aware of what's happened to the cost of construction since COVID.
Yeah.
We're about to go through a second version of that with the Brisbane Olympics.
I mean, if not already.
We were just talking before about Newcastle-based tradies doing FIFO work on Brisbane construction sites, which is, it's crazy to think.
Wow.
So that competition for trades, people are going to go where the money is. I would too if I was a tradie.
Yeah.
And right now, that's in the biggest infrastructure boom in the country, which is all the things in and around the Olympics. And we haven't even started the village or any of the key infrastructure around that. So that part of it will be interesting, because if you think about what we've seen with NDIS housing from an investment standpoint, this is a really, really relevant example.
And recent example. It's only happened in the last few years.
The amount of mum and dad investors that got burnt investing in new build NDIS housing because the only location that was feasible to build these homes was on the edge of town. Lo and behold, guess what? The tenants did not want to live on the edge of town. They wanted to be in established locations where there is good access to public amenity.
Yeah.
And unfortunately, what that has led to is a pretty horrific investment outcome for those people that put their money, again, in a location where they could afford to build new. So that part of it is not being spoken about, and that concerns me.
Yeah, I share that concern for sure.
And we haven't, as we've just touched on, we haven't seen the impact of the Olympics yet.
And I think that you can incentivize people to invest their money in anything through tax reform, but the supply has to match the demand. That's one thing, but the other part of it is not every investor is using negative gearing or needs negative gearing. You would deal with a lot of business people who are buying properties, for example, in a self-managed super fund. And so there's a lot of other macroeconomic kind of climate that is happening at the moment that isn't really being focused on. The Olympics, for one, what happened with the NDIS as well, I feel like there's a lot of noise. There's a lot of noise. And to I suppose, give some context on exactly what is changing, with regards to the negative gearing, to spell it out in real layman's terms, is that the offset can't happen with the regards to the loss of a rental property against your income on your tax return. So that is the change in a nutshell. That is not going to affect everyone.
You're right. If you've got cash that you can put into a property and your gearing or your level of debt is much lower,
it doesn't affect you.
You may be cash flow neutral. You may be cash flow positive, depending on the structure of how you own the asset and what you owe on it. So I think you're right. Like, there are still a whole heap of investors who have got capacity at this level. It's not everyone. We're hearing about all these potential ways that people can still access negative gearing. So one that has been touched on has been if you own your own residence and then convert that property into an investment property and go and buy a principal place of residence, the suggestion hasn't been confirmed yet, that property will be you'll be able to claim negative gearing on that first home. So there's a bunch of things out there that I think haven't been well thought through, and we'll see more on. But I'm with you. I don't think it is going to have the desired impact, and whether this is a political play or not, I think everybody in this country wants better access to housing for young people.
That is undeniable. There is one thing that is absolutely undeniable, is that the ability for the Australian to have the Australian dream of owning their first home, everybody wants. We touched really briefly on it before we jumped on camera, and we both kind of come to an agreement that there is no incentive for hard work in any of this. There is no policy for, we threw some loose ones around, let young people add triple their super balance into their super, it's quarantined, and it can only then be used for a first home deposit. And if they don't use it for the deposit, they get it at 60 when they get their super. Where's that type of reform?
Yeah. I can certainly talk to the objectives of the clients that I sit with each day and talk about, their investment goals. And for so many of them, the concern is their kids and helping their kids get into the housing market. So undeniably, we want that. We want better access to housing. But I think the concern across the board, as you said, is it's not well thought through. Fundamentally, I think the consensus is that this will not have the material impact that is suggested. It will not overnight improve the affordability for young people to get into the housing market. There needs to be more done around some sort of incentive linked to, obviously, people earning.
Hard work. And I think the basis of the conversation that we're having at the moment is very much on a macro level. If for a moment we just digress to the Newcastle specific market, right? Because in effect, we both predominantly work in Newcastle. We have got a gross undersupply of property. We have had some of the highest levels of immigration specifically into Newcastle in the last 6 months that we've ever seen, ever. And the reality is that we are Sydney's little sister. We're a third of the price in a lot of the suburbs. We've got some of the best beaches. We've got the lake. We've got Nelson Bay. We've got the wineries. We're 2 hours to Sydney. We've got millions of dollars being put into a Broadmeadow, project over the next little while. I think that losing a few investors because a change in negative gearing and a marginal change in capital gains tax that weirdly may actually impact people positively if you delve into it and look at inflation. Newcastle, I just get this feeling is going to be okay. Yeah. Would you have any thoughts on that?
I just think investors need to be smarter. They need to be looking at how they own assets, how they're structuring, how they purchase assets, and getting great advice from, obviously, a licensed professional around all that, of course. I think we are just going to see people plan their investments better. No longer is this a, hit and hope, strategy. No longer will that work. You do need to be very strategic in how you look at that.
I agree with that.
But to your point on the supply piece, the fundamental issue behind all of this is the supply-demand imbalance. There's a housing target of 1.2 million new dwellings by 2029. And I was reading just last week, I think we are 250,000 homes off target at the current run rate. So if you keep bringing new people into the country, which obviously supports economic growth, and that's a positive thing.
And it's needed.
It's needed.
To a degree.
But if you do not have a system that supports the efficient supply of new housing, then fundamentally everything breaks down. And that is what we are seeing. This supply demand imbalance is what's led to, sustained value growth. And
yeah, it's true. It's driven it the whole way.
Absolutely.
I don't think that's going to change.
I can't see it changing. And again, we've just spoken about the supply side issues.
Yeah.
Right. So short of the government putting further incentives in place to actually reduce the cost of a new build, which I can't see happening.
I don't think so.
That in itself is a problem. We've got red tape issues, and we didn't want this all to be negative, but I think if you look at the whole picture here, what you can see is that there is a much bigger issue than negative gearing that many would suggest are going to, it's going to result in not only a very stable property market for the future, but one which they're talking about, only slowing the growth rate by, a couple of percent.
$2 a week in rents.
Which I thought was the funniest statistic, but we won't go into that.
Yeah.
So, again, a big part of this was what are we seeing out there? And obviously you're, at the coalface, you're having conversations, and it sounds like there's lots of nervous vendors, lots of people who are worried about what will play out.
Mate, there is. I've been on the phones all day and the last couple of days, to be frank, and it's interesting because I took a phone call from an investor looking at an established house in a suburb that is not going to have, that the government's incentives or whatever it's going to be is not going to be applicable, and mate, he couldn't care less. I had a conversation with him, and his commentary was, I'm buying for the long term, I can afford it, and I know that there's stable capital growth. And so that one conversation is one of 30 that I've had. What I'm seeing a lot is that the owners of property are scared. They're scared. And, the mass media probably doesn't help with that, to be frank.
Yeah.
There's headlines and there's noise, and they think that the market's going to crash and all these things are going to happen. Like, we're in more trouble if interest rates go up 3 more times than what we are if the federal budget goes through. Yeah.
And I think for the most part, the tiers of the market that, largely won't be affected, so the owner-occupiers above, call it $1.2 million, those markets were flat as it was, and they were flat as a result of where things are at with the broader economy and where things are at with interest rates, of course. So I think fundamentally, if things change there and rates come down and immigration continues at the current rate and construction costs continue to escalate where they're heading, existing homes on a replacement cost basis will still be value.
Already. Correct. Like literally already. And so that's an interesting point, actually, if you break it down on a segment basis. Like some of the people who I'm speaking to who have, a little bit tentative about what's going to happen, when should we do this, is it going to affect our price? And some of them are in a $1.5 to $1.7 million price range. And I'm saying, guys, 80 to 90%, if not 90 to 95% of the people walking through your house, it's got nothing to do with them.
Correct.
They have but the issue is that the macro market are all absorbing this data and are all reading the headlines. And without an understanding of like what it actually is going to do or how it's actually going to affect the market, they just take the negative.
Yeah.
They just think the worst case scenario. So there's a lot of people who are sitting in their house right now who are going to have absolutely no effect by what has happened.
Yeah. Yeah, and that's the key, isn't it? Like that's where it is really important to have a conversation with someone who is out there and seeing it.
100%. Tom works on the buying side, I work on the selling side. So we speak on an incredibly regular basis about what's happening in the world. We've got a very similar thought process, but he gets to deal with the buyers. I deal with the sellers. And so it's very interesting to kind of collaborate and share thoughts on what's happening there. And to your point exactly, making decisions, you made a point earlier around mum and dad shooting from the hip investors. I have seen a lot of that in the last little while. I've seen a lot of people who are not represented. You look at America, every single buyer has representation. You look at Australia, I would go out on a limb and say, 5% of buyers have representation? I think that when there is noise, and I think that when there is a lot of things that are happening that are being portrayed in ways that may not actually represent the true facts of what is going on, there is no more clearer time than to surround yourself with professionals. And at the start of this, I said that this is not personal financial advice, and it very much isn't. This is two people who work on opposite sides of transactions, who work in the same sphere, having a chat about what's going on.
Yeah, I would say it's encouragement to get good advice, particularly as we've spoken about structuring and ownership and then where to buy. Like I think you just point it really well when you said shooting from the hip. That's what we've seen with a lot of last couple of years. People putting lots of money into great investments in Darwin and wanting to get a better cash flow return. When those people go to sell, their market was going to be other investors. All of a sudden, it is not. So the odd thing in all of this is that the owner-occupied dominant markets will continue to perform the strongest from an investment standpoint based on the long-term trends. No guarantee, of course. But certainly I think the investors that will be a little bit concerned right now are those that are bought in based on something surface level, like, oh, that's a better cash flow yield, and have ignored the fundamentals of the property market.
And the unfortunate part about society these days is that there is a lot of gurus on Instagram and a lot of gurus on Facebook who are pumping that kind of stuff.
Yep.
And a lot of the time people get swept up in it's too good to be true. You know what I mean? But I'll have a look anyway because it just might be that good. I go back to the instant gratification lifestyle that we live in. It's that I want it now. Do you know what I mean? And to that point about getting good advice, we won't delve into it now, but part of what Tom does, and he's quite a humble man. I don't know that he'll pump his tyres up too much, but part of what he does is they've got a really cool modelling tool. And, you don't need to talk about it, but there is a way in which if you get the right advice with regards to a real estate transaction, it can make a dramatic effect on where you end up, not just 12 months down the road, but 10 years down the road, 20 years down the road. The wrong advice and the wrong asset allocation, it can really hurt you.
Oh, you're spot on. And I think, look, we've touched on, some of the opportunities and, the ways of owning property that have been unaffected. There's also the opportunities on the other side of this. Like we spoke about investors needing to be a little bit more strategic about what they do.
Yeah.
Commercial property is untouched.
Yeah.
Right. So
self-managed super, we were talking about
self-managed super fund.
Yeah.
You can increase the rental yield on an investment that you hold. Granny flat type additions.
Yeah.
Yes, they may not carry the same benefits as the new build. They're not categorised as new build under this system, but they can still significantly improve the yield on an asset.
Well, and the only reason that you would want the new build is to get the negative gearing, but the whole idea of having the granny flat is to make that cash flow maybe neutral or maybe slightly negative, but still manageable, right?
Absolutely. And so if we think about what do tenants want, we need to put our investors cap on when we're thinking about this. Tenants want desirable locations. Whether they own the property or not, these people want to be as close as they can to employment. They want to be nearby good schooling for their kids.
Beaches.
Good local amenities. So all those fundamentals are there. If you provide more accommodation in those areas as an investor, you will do well from a yield perspective. And of course, there's many suggestions that by taking some investors out of the market, the yields will increase. We saw that with Victoria.
Yeah.
The last few years, the Victorian government imposed an additional land tax on investors.
Yeah, that's so true.
Which saw investors exit in droves. And Victoria's typically had pretty soft yields, around that sort of 3.5%.
Yeah.
Yields are in cases north of 4.5%. So we are talking about a substantial increase in rental, in cases more than 25%.
It's wild, isn't it?
It is wild.
And it just shows what an impact these things can have.
Totally, yeah. And
it just shows how the manipulation of like the tax system or what is going, what is proposed, it shows what an impact it can have.
100%.
Is it going to have the right one?
Yeah.
That's my only question. And if the basis of what they are doing is to try and make the Australian dream of owning your first home affordable is what they have proposed the right way to get in front of it. And, it'll be very interesting to sit back and in 2 years' time, sit down and have this exact conversation.
I agree. And because the consensus right now is they've missed the mark, and only time will tell as to whether that's the case, and only time will tell as to whether rents skyrocket and build prices head in the direction that they are. But a lot can change around, other elements of this too. Interest rates, we haven't spoken about unemployment, there's a whole bunch of other, forces at play or potential influences on, how this market responds. So I'm with you, it will be interesting, but there's going to be some great opportunities.
And do you know what's interesting? I was literally just thinking about an opportunity set in there. I think that there is going to be a dramatic uptick in properties that are purchased in good quality geographic locations that have duplex potential, that have townhouse potential. I think development sites have just gone through the roof overnight, should the proposals actually go through, because then you have got that mix of capital growth and you've got the negative gearing effects that you can still hold. So again, trying to go out and buy an investment property by yourself for the last little while worked. There is no doubt. You could kind of, to a degree in Newcastle, throw a dart at a dartboard, pick a suburb, buy a house, as long as it was sub a mil, sub 1.1, you'd be pretty good. Now you need to understand, what kind of legal framework am I going to buy this in? Am I setting up a trust, which we haven't even touched on? Am I setting up a company? Am I buying this? How am I going to buy this? Where am I going to buy it? What are my exit strategies? And the most overarching thing, which a lot of people miss when they're looking to invest, is, what am I trying to achieve? What am I actually trying to get out of this? And why am I buying a house?
That's the key. Yeah, and if you start with the end in mind, like anything, you'll do well, and you obviously do your planning around that. And it's a really interesting point that you make. And I think obviously a lot about, the clients of ours, our investors that we've helped over the last decade. And a big part of our strategy, one, has been to buy in owner-occupied dominant markets.
Of course, the resale.
Because of the resale.
Yeah.
But we will often look at a dual-pronged attack. So we will target properties where there is a large land component, where in 10 years' time, if my client elects to pull the trigger on a cosmetic renovation and turn this home into something beautiful, the market exists for that, they can do that.
Sure.
Or they can head down the road of going and get a DA. They can either develop the property themselves or sell it to a builder developer at a premium. So,
but you see, I deal with investors all day, every day, and the reality is they don't think like that. I will preface that. A large percentage of them over the last period of time that I've been working with them don't think like that.
Yeah.
And so again, if you have got the ability to purchase an investment property, you are trying to generate wealth. If you are trying to generate wealth, you need to speak to the right people. Financial advisor, accountant, buyer's agent. You need to surround yourself with the right people. I maintain relationships with investors a lot of the time who are actually, I am in contact with, who I've never sold a property to, but they'll speak to me about what the future resale is. Because again, they've got the end in mind. And so I just think that there is a lot of noise out there at the moment. There is still the ability to buy investment properties. There is still the ability to generate wealth. It'll be interesting to see what happens if the first home buyer market actually, gets the boost that it's, they've tried to implement this for. I've got to say, I have a relatively pessimistic view, but we'll wait to see what happens. But I think the key understanding or the key message out of this is, it can still be done. It needs to be done right.
Yeah, I'm with you. And look, it's certainly, we've spoken about the opportunities for vendors. Anyone with a property capable of a secondary dwelling addition, a granny flat, those are going to be popular properties. They're going to be very popular. Any of those, vendors holding corner blocks, again, really good scope for future redevelopment. So from a vendor standpoint, selling, at that investor level, again, like you said, where, the owner-occupiers still exist, those with properties that have got those attributes are going to do incredibly well. And from the investment side, like you say, you've just got to think it through.
Yeah,
you've just got to be a lot more calculated in how you approach this. And we've just touched on one example of a way to actually, potentially counter this, which is just manufacture cash flow.
Yeah.
get that outcome, or whether it's a commercial that you own and the tenant pays the outgoings, or it's a secondary dwelling or granny flat addition where you go from in cases $750 a week rental return to $1,400.
Yeah, it's wild.
It is incredible, through the addition of a box in the backyard that'll cost a couple $100,000 to build. So those opportunities exist. You got to know what you're looking for, and at the end of the day, like anything, good planning and good advice will help with that. But I think for your clients, for your vendors out there, as you've been doing, I don't think that the perception around a catastrophic shift in the market, I just can't see that playing out. But
I don't think so. I really don't. I think that obviously, I sell property in Newcastle, Lake Macquarie. I just think that there's too much going for this place. I really think that even if we lost a little bit, a few investors, maybe it would have an effect on a few different sales in specific scenarios. But I just believe that the attributes of where we live are really going to push us through. I think we're insulated. I say it to people all the time. I think Newcastle is, relatively insulated from the macro effects.
Yeah, well, and it's a good point. I think what we have seen playing out over the last certainly decade and even longer has been, we are piggybacking off the nation's largest economy, which is 90 minutes drive from here. Right, so the proximity to that strong economic base and the desire for young families to bring their kids up in and give them a better lifestyle is driving a lot of this. Particularly the tiers that we're talking about, the amount of clients that I've represented from Sydney over the last decade, and I'm sure the amount of buyers that you've met.
Heaps of them. Yeah.
They're not going anywhere, and
the relative affordability, right? So not only have you got the amenities, but then you've got the relative affordability. So having a laugh with someone a couple of weeks ago, a bloke who I sold a house to, and he said, "Mate, do you know that for this price, I would have bought a 1-bedroom studio apartment with no parking on a main road in Freshwater?"
Wow.
Bought a 4-bedroom house.
Incredible.
So it is just, and we are 90 minutes drive, let alone if we get a fast rail.
Yeah.
Like it's just crazy. So that for those reasons, when I look at the macro, economic negative outlook and everything's bad and the budget's going to kill us and all of this stuff starts getting thrown around, the whole reason that I wanted to jump on, especially with someone like you, who I really do value the input that you have. Like, you are not just your stock standard buyer's agent. The holistic approach that you take to how you help your clients and what you do is phenomenal. I have to say that. And I thought that we could just get across that it's not all doom and gloom. We're going to be all right. We've done this before. I haven't personally been through the GFC, but it's happened. No one died, and we still made it to the other side of it.
Yeah, the first thing that we do whenever we sit with a client is we look at the last 3 decades of the property market.
Yeah. And
there are instances of obviously change in policy right throughout that 30-year period. Mm-hmm. There has been change to monetary policy, the availability of debt, interest rates.
Yeah.
There's been GFCs, there's been COVID pandemics. There's always something else around the corner.
There is.
And at the end of the day, the resilience of the property market, and hence why it's such an attractive investment option for people out there, and the stability and obviously physical nature of property is attractive in itself. But yeah, if we were to bring this back to one fundamental thing that isn't going anywhere anytime soon, is supply and demand.
Yeah, which is the basics of any market, of any industry, anywhere. The basic economic principles are, if supply is low and demand is high, prices go up. And we have had such a chronic undersupply of property for such a long period of time that it is, even if we lost 30% of all the buyers, not just the investors, but 30% of everyone who walks through an open home, we still have 70%, and that might drop us from 30 down to 21. We've still got 21 people walking through an open home. Like, there is just so many people who want to buy in and around where we transact, and you would feel it on the buying side. Like, I would only imagine that we have conversations on the regular about how many times missed out on this, competed for that, didn't get that. Like it's not easy to buy a property. So I think more than ever, it is really important, and we've harped on it a couple of times, but it's really important to get the right advice. Over the last little while, what I've seen in real estate from a sales perspective is that you could be a monkey in a tuxedo, stand at the front, put for sale in crayon, put it in the window, and someone would drive by and buy the house. Now we are seeing things, and we laugh about that, but I actually think it's true. Maybe not a monkey, but the reality right now is that we have got a lot of noise. We have got a global economic climate that is at war. We have got interest rates that are increasing. We've got some of the largest household debt that we have ever seen. So the market is shifting. It is moving around. And I think that if you are looking for an agent to represent you in the sale, you need to make sure that you've got someone who knows what's going on. They haven't had to have a strategy for a long time. You negotiate with multiple different selling agents on a regular basis. And I could only imagine that some of the interactions you have with them, you leave and you think, God, I bought that cheap. That bloke or that girl had absolutely no clue what they were doing. And I think that that's, from the buy side, you need to have your ducks in a row. You need to make sure you know what's going on. You need to structure yourself well, think about the end in mind, model, do all that type of thing. Completely agree. On the sell side, it's not exactly the same, but the principles are the same. You need to have a strategy. You need to have someone who knows how to negotiate. You have to be adaptable.
Particularly like we've spoken about, one in the shallow buyer pool and those upper tiers, if you burn a buyer in this market right now, then you've potentially cooked the entire campaign. In the lower tiers, there's still a really important element to this, because if you've got less buyers, less genuine buyers who are capable, you can't afford to get it wrong. So bringing that deal together is ultimately about pegging buyers against one another, and if you've got a limited number of those, you need to be a little bit better at it. Like
and sometimes you don't have multiple. Yeah. That's another important thing to note, like holding deals together. Having an agent on your side, both a buyer's agent, and I can't believe that more people don't use buyer's agents, to be frank. I really can't believe it, because think about the amount of deals, and you and me, we sit here and we have jovial conversations, but we're on the opposite side of transactions on a pretty regular basis, and we go head to head, and that's part of the business. There's no love lost out on the battlefield. But the reality is that we collectively have the ability to hold deals together and put them together. And if you think about the amount of times that you and me have been on the opposite side of things with opposite interests at heart, but we have had to dig in and really, really try and hold a deal together in an outside of the box way that could only be done by two professionals who understood their role in their industry to the highest level. Why on earth, when somebody's looking to buy a house, would they not have representation, if you think about it like that?
Well, and I think what you just touched on then is knowing how to keep a deal alive as well. Because there has been a few where I would say that most buyers are going to walk away. They're not asking the question. They're not haggling. They're not.
They don't know they can as well. A lot of the times they just don't understand the process.
Correct. And that's what it's. So whether it's selling or buying, the same is true. You've got to bring to this 100 other experiences that can help you tackle that unique situation that you're about to face, and there's a value in it. But I think right now more than ever, for those nervous vendors, someone like you who is, has an intimate understanding of what's playing out there will help, obviously approach a campaign in the right way.
Yeah.
And look, from our side, it's just about making sure that, our clients have got a whole world view on this and understanding what their different options are, because this is, even if we say this takes one option off the table, there's plenty of others. So
yeah, I agree.
Get some good advice.
Mate, listen, that has gone for longer than what we thought, and we digressed as we usually do on the phone, but I think that this has been relatively informative. I wanted, we spoke about it at the start, we just wanted to bring a little bit of level-headedness to what's going on out there. There's a little bit of calmness to the storm that's kind of been created, and just let all of the people knowing, whoever is watching this, that we've been through things like this before. It will take some kind of restructuring. We've got to wait to see what happens if it even gets through and passes legislation. And if it does, we adapt. And I think that's what true professionals do.
It's just time to get on with it.
Time to get on with it. Move on. If you need anything with regards to selling your house, if you are giving thought to selling an investment property because of the new proposals, if you just want to have a chat about what is going on in the market, because this is a general chat in nature, but we both individually have the ability to really specifically delve into the set of circumstances that are in front of us. Because the reality is that I see myself, I don't know about you, but I see myself like a tradie who turns up to a job site with a truck full of tools. If I don't know if I'm hanging a door or putting a roof on, I don't know what tool to bring out. And so we can be generalists here, but when we actually sit with people, or when I sit with people, I should say, I'm sure you do the same, and we actually delve into exactly what is going on in your life, ask 1,000 questions so that I can get a complete and utter understanding of what is important to you, what are the pain points, and how we can possibly make it better. Then we can use that information to really put a strategy in place. And that might be a 2-minute phone call just to say, hey, this is what I'm thinking about doing. Do you have any thoughts on it? And then 5 years later, you sell your house. Or it might be a 2.5-hour sit-down meeting where we go through absolutely everything because it's incredibly intricate. And we gather that information to be able to put the right strategy in place. You know, I'm sure that you do something similar, and my contact details will be down below, and Tom's will as well. Did you want to have just 2 seconds about your modelling and what you kind of do in that regard?
Look, I think what you just touched on, Josh, is right now those are valuable conversations to having. Whether you're selling or whether you're buying, it's about understanding the whole picture, understanding what your options are, and using evidence to inform your decisions. And that's what we are very big on. You know, all the work that we do with our investor clients is forming a view based on an evidence base. And there's no crystal ball out there, that's for sure.
No.
But you know, we are blessed in this day and age to have access to some incredible data that has shown how the market has performed in situations where there are major changes, and also how that market has performed a decade after that. So, you know, forming a view and having a timeline and an understanding of your options, and then making those decisions, you know, with, you know, more holistic information than perhaps what's, you know, been put in news.com articles at the moment.
Yeah. And another thing that I really like is when because I've had a bit of a chat to you obviously about how you deliver this type of information. It's like the equivalent of going into a doctor's surgery with a broken leg. You get an x-ray, and a lot of the times the doctor will just chuck you the x-ray and say, self-diagnose. You know, here's the data, go for it. It's like, but the alternative is the way in which you then interpret that data, the way in which you then bring it together and make it adaptable to specific people's circumstances is what I think sets you apart at times. Explanation, you know?
Well, and we've rattled off a couple of good analogies here. You've hung a door and broken a leg, and
there's more to come. Watch this space.
No, I like it. It's absolutely. It's about actually cutting to the core of the issue and properly understanding it, or the objective. You know, in the case of what most people are wanting out of this, which is, you know, they've got a goal in mind, they've got an aspiration, they've got somewhere that they want to get to. It's just about coming up with a better plan. You know, more thought out plan at the moment, and we can definitely help you with that, as Josh can with helping you come up with the best way to approach selling your home.
Well, it's supposed to be a 5-minute quick video, and our videographer is sitting behind the camera with a smile on his face. So for now, I think we'll leave it there, and I'm sure there'll be another one to come.
Beauty. Thanks, Josh.
No worries. Thanks, guys.